Hello friends and subscribers, a very warm welcome back to Readings in Impact Investing. My name is Daniel Rosehill and this is a new podcast and a YouTube channel I set up to read important material in the world of impact investing. Think those reports sitting on your desk for the past 6 months. Now you can bring those reports into your ear and get them at the gym. So this is as I said, it's a brand new podcast with reading out these documents so that they can receive a wider listenership. We have a website called readingsiниmpact.org. This is a non-for-profit initiative. I set this up because I thought it was a good idea, essentially, that this would exist. And my email address is public@danielrosehill.com. So if you have a report that you think would benefit from being distributed in this manner, do please be in touch. Today we're going to be looking at a report from the IFC, the International Finance Corporation. And it is a World Bank document policy research working paper. It's 29 pages and there is a web page as well. And this is talking about sustainability linked bonds. So this is an instrument, sustainability linked bonds and loans, SLBs and SLLs. Their issuance has just mushroomed over the past few years. They're quite interesting forms of debt in which the rate of interest is linked to environmental indicators that the borrowing entity has to try to meet, and there's step up and step down coupons. In other words, if they meet them, they pay less for the debt, and if they do poorly, so there's step up and step down penalties. So I think I'm going to just read the web page and then I'll read the actual report. So this is again coming from the IFC, and I'm reading this on the 1st of January 2024. It was posted on the February 15th, 2023, so it's just about a year old, but I think this remains very topical. So, at a glance, sustainability-linked bonds are so let me just give the author before I do any reading whatsoever. Imtiaz is an economist at the Economy Policy Research Department at IFC. He holds a PhD in finance and has published on topics in financial markets, investments, and financial technology. Djeneba Doumbia is an economist at the Macroeconomics, Trade and Investment Global Practice at the World Bank. So apologies to both of these authors if I botch their names or botch their pronunciation, but this is their working paper and they're the same co-authors on that paper. So at a glance, sustainability-linked bonds are a promising pillar of sustainable finance that can help raise the funding needed to underpin successful energy transitions in developing economies. The bond structure, as well as how they are regulated, will need to evolve to meet the demands of a fast-growing and maturing market. Key findings. New research underscores the need for a robust design of sustainability-linked bonds to ensure greater impact and encourage future market growth. Two structural features in particular, target dates and callability provisions, can influence the efficacy of incentivized sustainability targets embedded in these instruments. Addressing these issues, particularly for borrowers with poor environmental performance, can help to maximize the bond's sustainability impact. More rigorous industry standards, robust third-party verification, and greater awareness are essential to address investor concerns. The market for sustainability-linked bonds, which set financial incentives for borrowers according to their performance against environmental, social, or governance standards, is one of the fastest-growing corners of finance, with over $100 billion issued globally in 2021. But it is less than 5 years since the first use of the instrument, an issue by Italian utility NL in 2019. And the bond structure, as well as how they are regulated, will need to evolve in response to the demands of a fast-growing and maturing market. Recent research by IFC economists identifies two bond features that can dilute their effectiveness in promoting more sustainable business practices. Addressing these issues would help to reduce the potential for bond issuers to circumvent financial penalties imposed for failing to meet sustainability targets. Sustainability-linked bonds typically set the interest rate charged on the debt according to whether the issuer meets goals in areas like renewable energy use by a predetermined deadline that falls before the debt matures. Failure to meet that target may result in a more costly interest charge, referred to in bond prospectuses as a coupon step-up penalty. Some bonds include a step down, where exceeding the target results in lower charges. I'm just going to pause here and remark that this is actually extremely important, that not all SLBs have a step down coupon. Some of them just have a step up coupon. Some, of course, it would be possible, to the best of my knowledge, to have both. The mechanism, there's actually a few different variants within this new class of debt, and those are obviously very significant differences. Linking borrowing costs to sustainability targets distinguishes these instruments from other securities focused on sustainability, like green and social bonds, which do not vary the interest rate but commit the borrower to spending the proceeds on projects that meet environmental, social, or governance standards. And again, this is just really important because it does get confusing. There is sustainability bonds and there's sustainability linked bonds, and they're not the same thing. SLBs have this varying thing, and they could be classed as pay for success instruments. A sustainability label bond could just be a regular bond that has to go towards some sustainability linked initiative. So they sound almost the same, sustainability bonds and SLBs, but that's a very significant difference in their mechanism. Sustainability linked bonds purport to avoid the question of how to enforce standards, since the interest rate penalty acts as the enforcer. However, an analysis of all sustainability linked bonds issued before the end of 2021 identifies two ways in which the bond's design could weaken the effectiveness of those penalties. First, deadlines set too close to the end of the bond's term reduce the number of coupon penalties an issuer would have to pay in the event of failure to meet sustainability targets. Second, a right to buy back and cancel the debt before it matures, known as a call option, and a common feature of these bonds, enables issuers that fail the sustainability test to call the debt and avoid penalties added to the remaining interest payments. The IFC study presents evidence suggesting that most bonds with step-up penalties have target date in the latter half of the bond's term. Some even set it in the last 10% of the period. Exhibit 1 illustrates this, showing a higher proportion with the deadline in the second half of the bond's term, in stark contrast to securities with step-down charges. Moreover, bonds with larger coupon step-up penalties are more likely to have target dates. Meanwhile, the study also finds that SLBs are 3 times more likely to be callable than corporate green bonds and 5 times more likely than conventional corporate bonds. Furthermore, bonds with coupon step-up penalties are more likely to be callable than those with other types of financial incentives where callability does not affect penalty dropout. So these are just really, really important. I don't use the term flaws, but potential flaws, right? Are ways that companies are issuing these, and it sounds all great and sustainable, but there are mechanisms in place that frustrate those sustainable goals. And I guess this could really be considered a form of impact washing or greenwashing. The study further uncovers evidence that call options may be structured in a manner to minimize potential penalties by setting the first call date close to the target date for meeting sustainability goals. Step-up coupon penalties are only imposed after the target date, so there is little incentive to call a bond before then. However, the total penalty amount increases with the duration of time after the target date. Therefore, a borrower interested in exploiting the call provision to minimize penalties is better off calling the bond soon after the target date, and hence should set the first call date to reflect this. Exhibit 3 shows that an overwhelming proportion of callable SLBs set the first call date within 6 months of the target date. Why does this matter? Sustainability-linked bonds are a promising pillar of sustainable finance that can help deepen the capital markets of developing economies, which urgently need funding to underpin successful green transitions. However, to realize their potential, it is critical to strengthen the structures of these bonds so that they shift borrower behavior towards more sustainable actions. It is crucial to address the structural issues outlined above. This can be achieved by setting target dates and first call dates at an appropriate point in the bond's life, as well as introducing adequate penalties on calling a bond while sustainability targets remain unmet. Doing so can signal to the market that the embedded financial incentives are strong enough to motivate a shift in borrower behavior. This is especially important for high-emitting borrowers, as the study finds that their issuances are more likely to raise the concerns highlighted here. Improved design of SLBs will increase their appeal to investors and ultimately underpin their effectiveness as key instruments of sustainable finance. Policymakers and financial institutions can facilitate this evolution by increasing awareness and encouraging investors to scrutinize bond offerings more closely. Industry-driven standards such as those of the International Capital Market Association can also play a role by expanding their scope to incorporate structural issues. Raising standards, improving transparency, and increasing oversight would help to maintain the impressive momentum seen in recent years by the sustainability-linked bond market.